Hello, hello. Let's get it going. Um, so today we are going to obviously tap into the live from Jerome Powell today. We'll listen to his speech. We will, before that, talk a little bit about the state of the world, what is going on with this war in Iran, as well as oil markets and the implication that that's going to have on the economy and the world. As it stands, I do not think that I can continue to see that no one is really paying attention to this or doesn't seem to care, and that's gonna be interesting. We'll see what people are asking about at the press conference with Jerome Powell today. I think that'll definitely come up at some point. So we'll talk about what's going on a little bit before this press conference. We will also listen to Jerome Powell speak. And then after he's done, I'll do my best to break down what he said and decode the language from the speech. And then we will pretty much call it a day from there. So welcome in, everybody. It's good to see you. I'm going to check out the chat here. Hello, hello. Quickly, let's go ahead and take a look at oil prices because we had an event happen overnight here that is having an influence on oil prices, from what I understand. And yeah, it's here's where we're at. This is Brent crude oil. It spiked up to 106. It's currently hovering around 103. Obviously, this is a drastic change from where we were a few weeks ago back in the 60s. This right here, right, this going up like this and spiking at such a rapid pace is something that will have a very massive impact on the economy. Okay, this is not something that is a very good thing. And if this continues to rise, then it'll certainly disrupt things. So um, there was this clip that was circulating around not too long ago that was basically all about how um, if you have a rise in the price of oil, that can be good for companies, right? Because you make more money as the price of whatever you're selling goes up. But then what eventually happens is you get demand destruction when the price goes too high because eventually it gets prohibitive to where I can't do anything anymore, right? If the price is actually that high. So we're not at that point yet, right? So that's certainly a good thing, but definitely something to keep an eye on. So yeah, someone just mentioned that the SEC made multiple cryptos commodities. So that's something that has also happened in the background. I'm going to drop a video about that tomorrow. The SEC has basically clarified the application of federal securities laws to certain types of crypto assets and certain transactions involving crypto. So just really quickly for everybody, while we're here, basically they've created a taxonomy breaking down what the different cryptos categories are. They've got digital commodities, digital collectibles, digital tools, stable coins, and digital securities. And they have also clarified that protocol mining, staking, and wrapping are not involving the sale of a security in those transactions. So something to keep in mind there as well. And speaking of crypto, I have very recently announced a partnership that I have with Caleb and Brown. And you guys can actually sign up with my link for Caleb and Brown. It's in the description of this video. And I'm going to put it in the chat as well. And essentially, this is my broker of choice when it comes to cryptocurrency. With the Caleb and Brown exchange, if you're still looking to get involved, right, with crypto and you just don't know where to start, or you're looking for somewhere where you can know reliably that you'll be able to trade in and out of your crypto and actually take money out of the market when the time comes to do that, Caleb and Brown is a great place to go because the thing that makes them unique is that you have an actual broker there, right? That is there for you to speak to when you're making a decision about what you want to do with your digital assets or to help you educate on even how all of the stuff works in general. So if that's something that you care about, and also the fact that they have unlimited withdrawal amounts, right? There's no limits on your withdrawals. It's another major thing that I love about Caleb and Brown. If that's something you're interested in, click the link, set up a free account. It'll ask you to verify your account via email. Just make sure you go through that process, and then you can get in touch with the broker over there. And in case you just have extra questions and you don't know exactly what to do with this, I've actually gone ahead and got my contact over at Caleb and Brown Jim to graciously allow us to email him. So I put his email in the description as well. So if you have any questions, just reach out to Jim and basically say, "Hey, I'm interested in learning more about what you guys are doing at Caleb and Brown." Mention that you came from Keith D's channel, and then he'll get back to you ASAP and help to speed up the process of you getting in touch with the broker. So, welcome in everybody. We're about to kind of break down a little bit more of what's happening in the markets. But in the meantime, we had that announcement from the SEC, and I wanted to take that as a moment to let you guys know about my partnership with Caleb and Brown. Set up a free account, it's free, and then you can start learning more about crypto. And if you want to get involved, then this is a great venue to get that done. So, with that being said, a few things that we got to touch on today. So, as I mentioned, oil has spiked. You got Brent crude surging up to around 110 a barrel. And we've got the fact that the oil market is starting to disperse. It's starting to get different prices in different markets. All right. So this guy, Hijun Park, has outlined what he is seeing. And I wanted to share this with you guys. So oil is trading a lot higher in Asia. Okay. Apparently around $150 in Asia, where it's trading at $100 in America. So there's a pretty big gap. And obviously the reasoning being is because a lot of the oil that's coming out of the Strait of Hormuz is that's a lot of the oil coming out of the Strait of Hormuz is going to Asia. Okay. So with the Strait of Hormuz still being closed, by the way, it's still completely closed. That's creating massive issues for the situation here in Asia. And quite honestly, it's going to continue to be a problem around the world, including in the US. So the US has released some oil from the Strategic Petroleum Reserve, which is already at some of the lowest levels that it's been at since the 1980s. And at this point, the situation is just not getting any better. That's all I can really say. Overnight, we just had the bombing of a very important uh, oil depot and oil field in Iran slash Qatar. So that's another thing to keep in mind. We've had some attacks that have happened in Dubai as well, and potentially are going to continue to escalate because of the fact that we just had a bombing of this large oil field in Iran. And so here we are. Yeah. Sometimes the link messes up with YouTube, guys. Jeez. The link is in it's in the chat. So use the link in the chat. I see what happened there. That's great. What in the world? Yeah, so use the link in the chat, guys. But anyways, yeah, so this situation with oil is continuing to heat up. Okay, I see what's going on here. There's a huge issue here. Oh man, these streaming softwares are just a lot of fun. All right, folks. So the next piece that we got to talk about is basically why I want to talk about why the Strait of Hormuz situation is so dire. Okay, because and we're just waiting here for Jerome Powell to come on. To be clear as well, guys. My goodness, there's no rate change. Okay, which we all knew coming into today. No rate change. Okay, and we will hear Jerome Powell come up and speak in about 20 minutes or so. So let me play this video for you really quickly to talk a little bit about why the Strait of Hormuz is closed, why it will stay closed probably for quite some time, and why it's going to be really difficult to try and escort ships through it. Right? The U.S. has said, "Oh, we'll just provide some protection for any ships that are trying to go through." Well, that's not something that's very easy to do. And let's hear this guy break it.
Reopen the Strait of Hormuz.
When the time comes, the U.S. Navy and its partners will escort tankers through the strait if needed. I hope it's not going to be needed, but if it's needed, we'll escort them right through.
And he wants countries like China, Japan, South Korea, and members of NATO to help. But so far, no one has volunteered to protect commercial shipping from Iranian attacks. In just 2 weeks, the U.S. says it has destroyed dozens of Iranian Navy ships. But Iran has many asymmetric weapons it can use to target ships, including missiles, drones, naval mines, and speedboats. And because the Strait of Hormuz is so narrow, reaction time could just be seconds from an Iranian launch site to a targeted ship. Meanwhile, escorting cargo ships also requires a massive force. One estimate suggests 8 to 10 destroyers might be needed to protect a single convoy. The U.S. Navy has only about 50 combat-ready destroyers spread across the globe. Even if such a plan works perfectly, analysts say escorts might only restore about 10% of pre-war shipping traffic. Since the U.S. and Israel attacked Iran on February 28th, commercial shipping through the Strait of Hormuz has nearly stopped. And that's a huge problem because about 20% of the world's oil passes through this narrow channel. Iran's drones and mines are cheaper and smaller than U.S. warships. Just one strike can immobilize an oil tanker or cargo ship worth tens of millions of dollars, which is why the world's most important oil choke point is effectively closed, a bottleneck that's costing the global economy billions of dollars.
Okay, so a big piece of that as well is about the fact that, um, like the missiles and all of the defense systems and whatnot that are on these naval ships, right, are usually for offense, right? It's not really meant to protect anything other than itself, right? So you've got all these big warships, and they're not meant to go out and uh, escort another ship. The systems are designed to protect the ship itself. Okay. So that's another piece of it. And the amount of resources that the US would have to deploy to try and do this on their own is also not really very realistic. This is why potentially they've been asking others to help with this process of escorting things through. I wanted to share this video of this guy talking a little bit about the situation as well. I think he had an interesting take that is worthy of listening to, speaking about how essentially this is going to have an impact on the US dollar and the petrodollar system. So let's tune into this real quick.
Our dollar has no value. It's not backed against gold or silver. What the US has is the petrodollar. The US worked out deals to make the US dollar the international currency for oil trade across the globe. So if we are not trading oil in dollars, the US has a major problem because our dollar has no value without the strength of the petrodollar. Our government would collapse if people stopped trading in USD with oil. So when Iran shut down the Strait of Hormuz, they made an alluding to that. They said, hey, if your oil and liquid natural gases are not being traded in USD, any other currency, especially the Chinese yuan, with the rise of BRICS, will let your ships through. They are actively trying to devalue the United States dollar because they understand that if oil is not being traded in USD, the US dollar is worth nothing because it's not backed against anything. This is also why we went into Venezuela. In case y'all didn't know, Maduro was going to start selling oil to China, but using the yuan. He was going to stop using USD. And that's when the decision was made very quickly to go in and take him out of power and try to get American oil companies to Venezuela to take over oil extraction and processing there to keep it in USD. Because if we start losing those trades using the US dollar, we lose value of our dollar, which will cause an economic collapse or at least a massive recession. So now Trump is panicking and demanding that other countries send military aid to the Strait of Hormuz to make sure we can open it up and get it all open. And, but we also already destroyed their military, so you guys, don't have to worry. We've already taken out their whole everything. But they might have put mines, so we just need you guys to come and help us out. Why can't y'all handle that? Why do you need other countries to handle that? No, you know that if other countries start to go into an energy crisis because oil isn't moving, if they have to buy oil in a different currency, they will, just to get the oil to their country. And I think this is why Trump wants other countries to get involved, to try to keep the status quo. But a lot of the countries are saying, absolutely not. We are not going to get involved, even if they don't realize it's about the petrodollar, but they will not get involved as of now. This is really concerning, and this is sad also that Iran is playing a really smart game that Trump and his team had no idea they would play. I do think people were aware that Iran had these cards to play, but somehow it eluded Trump and his whole entire team. But this is a major concern for the longevity of the United States, especially with the cost of this war, how much money we're spending on this war, especially when you hear that we've been borrowing $50 billion a week for the last 5 months. That means we're going to have to pay that money back, or we're going to have to pay back the interest. It's all of a mess. So much money is just being thrown around by the U.S. We're just hemorrhaging money everywhere. But if the U.S. dollar loses value, we have to pay even more in interest. Not just us as consumers, but the government itself. That means our dollar, that $1 trillion of debt, would suddenly get higher because the $1 trillion USD doesn't matter anymore because it will be so devalued. So this is a major issue, and I don't know if it can be resolved. Iran has made it clear this is on their terms. And, the more Trump keeps talking about, the Strait of Hormuz is open, it's not. Some ships have already tried to go through and got blown up when you said it was safe. So now nobody wants to move. And insurance companies are not insuring those boats. So you have to wait for the insurance companies to insure the boats before people are going to want to move their boats. And now we also have a problem of oil production has been shut down in a lot of these Gulf countries and Middle Eastern countries because they have nowhere to put it because boats aren't moving. And it takes weeks to months to get those processes back running again once you turn them off. So I don't think Trump ever had a plan to mitigate this, let alone knew what he was doing or what Iran was capable of. But I do think they're starting to realize with this move, this is just a statement, whether Iran's actually doing it or not. If you're trading in anything but USD, other than that, you can go through. I think they're starting to realize what the game is, what Iran is trying to do. And Iran could very, very, very easily be successful in devaluing the US dollar since it's backed in nothing. But we'll see what happens. I doubt we'll get the truth on American news, but this is just me on my hunch.
What do y'all think of that? We've talked about this pretty extensively, right? Especially initially as we saw the whole switching of the narrative around, ships can come through if they're traded in yuan instead of USD. And that put the entire conversation around the petrodollar center stage, right? Only reason the US dollar has any value is because it's used in global trade, right? It's a reserve currency asset. The U.S. Treasury market, right, has essentially become now the most liquid market in the world because of that. So now if you want a place to park your dollars, you want a place to park wealth, money, U.S. Treasuries is one of the best places to do it, especially as a sovereign nation, right? So something to keep in mind there, obviously, here is if we don't have control over what oil is priced in, then the U.S. will not have control over the globe in general, right? It will lose its dominance over the world. Now, the other piece of this that we've talked about is, well, maybe what's happening is if no one comes to help to open up the Strait of Hormuz, then you now have the U.S. being the only force there besides Iran itself. And in that situation, well, wouldn't the U.S. kind of have their ability to have control over the Strait of Hormuz? So could the game be that Trump is trying to basically maintain U.S. control over the Strait of Hormuz? And if no one comes to help, then that essentially solidifies that position. So anyways, just wanted to kind of point some of that out as we continue to wait here for Jerome Powell to come on. He'll be here in just a minute. The other piece that I will go into here is that someone was uh, trying to figure out what to do. I'll tell you what someone else has done. You have Congressman here, Representative Josh G, who just filed some new stock trades. He just filed his first ever purchase of Exxon. Is that not something we talked about on this channel before the war even started? He sits on the House Intelligence Committee, so I think they have a certain period of time where they're allowed to file the actual alerts of this. So it could have been that either he did this right before the war started. It could have been that he has done this after the war started. We don't 100% know. But this guy said, my screen is red, or Trade Oil Stocks said, yeah, Hormuz is probably staying closed for a while. Dude on the Intelligence Committee decided to go into Exxon at all-time highs. Kind of joking there, kind of not, but definitely something that is worth paying attention to. We've talked about Exxon. We've talked about the ETFs in that space that also pay dividends and things of that nature. Anyway, so Ji-hoon Park laid out a few steps for what he thinks that what's happening here means for oil markets, including specifically the difference between the price for oil in the Middle East and in the US, right? There's a big gap, and he's talking about what does all of this really mean? Step one, he says that the two-tier oil market is now a reality. Step two, Asia will enter demand destruction. $150 oil is going to kill manufacturing. China and India cannot absorb this, he says. Factories will slow down, orders will stop, supply chains will break. South Korea has 26 ships stranded in the strait right now. You've got Thailand, Philippines, Singapore, all facing energy emergencies. Step three, strategic reserves drain fast. The International Economic Agency, or excuse me, Energy Agency, something like that, released 400 million barrels. U.S. has taken out 172 million barrels from their strategic petroleum reserve. At current consumption rates, these reserves last weeks, not months. Once they're empty, there's no safety net left. You can't refill reserves during a war. So that's the next thing he said there. Step four, gas prices explode in the U.S. WTI at $96 means U.S. gas hits $4.50 to $5 a gallon soon. If the strait stays closed for over a month, for another month, then you would get $120 WTI, or $6 plus gas potentially. And that would hit consumers directly, and spending would drop, recession risks would spike. Step five would be inflation comes back with a vengeance. Oil feeds into everything: transport, food, manufacturing, plastics. The Fed is meeting right now. Rate cuts? No way. Rate hikes would be back on the table, trying to get inflation in check. Step six, Iran holds the cards. Iran controls whether Hormuz opens or not. The U.S. is bombing them and asking them to reopen the strait at the same time. You don't bomb someone and then ask for a favor. Iran has zero incentive to reopen. Every day it stays closed equals more leverage. Step seven, the worst case scenario. Hormuz stays closed for months. Oil hits $200 in Asia. The U.S. SPR runs dry. America loses its buffer. Global recession triggered by an energy shock. 45 million more people pushed into food insecurity is another thing that has come up here as a potential worst case scenario. So this is something that could potentially play out, right? If oil continues to stay at these elevated prices, and if the Strait of Hormuz doesn't get open, the prices will rise even higher. So, yeah, guys, I think once again, as I've continued to say, right now everything is super calm. Like, to me, this feels like the calm before the storm. It feels like January 2020, when some people knew what was going on in the world, and some people saw that there was a potential for a very, very major issue. And others kind of were just out partying and chilling, you know. And that's just a part of the game, right? That's just how things go. Until things come to your backyard, you might not be so influenced by it. And right now, there's a lot of people who are not seeing the impacts of this. Some people are, right? Like we said, in Asia, they're already seeing it. But there's other parts of the world that are not seeing it. So let's look at really quickly the rest of the markets, what's going on. NASDAQ very slowly grinding its way lower. S&P 500 also slowly grinding its way lower. Nothing massive happening there. Same thing for the Dow Jones. Let's look at Exxon, right? We keep on hearing about Exxon. Exxon starting to make another leg higher. What about Bitcoin? Everyone's been talking about Bitcoin this week because it started to push up a little bit. It got up as high as $75,000 yesterday, it seems, and now pulling back down a little bit lower. You guys know my take on this. I'm expecting the prices to likely continue lower from here. I'm going to continue my personal plan of just dollar cost averaging, no matter where we get to, and just playing the game, right? So anyways, this is kind of what I'm seeing here. It's just we've got a major level that we were looking for in Bitcoin, not expecting anything before we get down there. But anything can happen here. One thing with Bitcoin is that there's a chance that it plays into a new narrative. I was talking with Ben over at Memes and Markets, and yesterday we were talking about what would change the situation for Bitcoin. By the way, if you haven't already, you gotta subscribe to Memes and Markets. We go live every Tuesday and Thursday, and we chat about what's happening in the world holistically, as well as what all of these things mean for cryptocurrency and blockchain technology. So anyways, guys, this is a little bit of what's going on in the markets at the moment. Energy, right, continuing to perform. This is the XLE ETF continuing to rise higher. We kind of saw this continuing ever since December 2025. Prices have just been absolutely going higher for the XLE ETF. And I think we can probably expect to see further gains for energy stocks in this time. So anyways, guys, anything else that you guys want to tap into really quickly? We're about to have this press conference here in just a couple of minutes. So I will chat with you here in the chat until we get Jerome Powell up. Eminem is the ish, Trev Stu said. It really is. It's a really good time. The link is in the description as well, so you guys can go and follow and subscribe. Now I'm seeing that like all those links were actually not going to work today, so let me give you guys a link in the chat. Go subscribe to Memes and Markets. It's a good time. And we learn so much together. And it's just so worth it. So far. All right. What up, chat? Oh, yeah, we do have an amazing guest tomorrow on Memes and Markets. Guys, we were chatting with one of the top oil sellers and top oil influencers in the world, guys. So tune in. And he's actually somebody who's super crypto conscious. He's very aware of the conversations around central bank digital currencies, the work that the BIS has been doing around central bank digital currencies. And I'll shut up.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, First, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total inflation, total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? I'm just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially it is that, the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods. And on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
The consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction to your point, if we have high, if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
Mr. Chair, in the past, the staff higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past.
Yeah. So there'll be an offset.
Offsets, yeah.
So that's true. We're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period of time, meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that, having looked through tariff inflation and inflation running above target and looking through the oil price shock, would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision-making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had, we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations, and so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%, and I think it's important that we do that. Very important.
Nick.
Nick Timmeros, The Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well, as you just outlined. What gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers, on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system, and we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system, so that goods inflation will return closer to what it's always been. I mean, it used to be for many years it was negative, and then the year before tariffs came in, it was 0, and it's running at like 2% now. So, and so that's kind of goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive, restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services, but we're not seeing progress there. So we do, what we expect for next year is what we want to see for this year, rather, is continued progress on housing services, finally seeing that the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see, but it's a good question why we didn't see much of that last year.
Edward.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can. We're at 3.0% core. Inflation 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time, and that's a concern. We need to get back down to 2%, and we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality, and I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply-side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. In a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think a good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent, really, growth in the labor force, which, of course, we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So we look at that, we see it, we get it, and I mean everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless it's something we're watching carefully, and are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless something we watch carefully.
Andrew. Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking account of the risk of supply shocks as a more common problem?
You know, we did go through a long period where the shocks were all demand shocks, and you know, so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure, and it's just a very different thing and a much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But you know, has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And you know, the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But you know, there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but you know, I guess, you know, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, you know, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And I wish we had been able to do some things, but you know, we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy that the possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case, and of course we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You know, you can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business services as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices?
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. Sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there's tension between the two goals, right? The upward risk for inflation and downward risk for employment. And that puts us in a different situation. When we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's 1 percentage point above that. So calling that stagflation, it's not. I would reserve the term stagflation for a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very different thing like what they faced in the 1970s, and I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do, but in this case we're going to learn a lot, because we're going to learn 6 weeks to the day till the next meeting, and we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook the way the outlook evolves with what happens in the Middle East, that's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just, I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023 when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year, they should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I think that the theory is probably right, but as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. So I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing is our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history. And then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc. And for all the tariffs, they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases. And we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But the administration said they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Chris Rugaber. Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year.
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change based on events. Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction, and so I just think we do it. And I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think, but we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one though, I think it's even more than usual good to take the forecast with a grain of salt because it's subject to just very high levels of uncertainty.
Brian. Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, there were big price increases all around the world, by the way, everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet, and it will take some years of positive real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed, and there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and what it does for us is makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and stable prices is half of our mandate. It's one of our two mandates, the maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States anywhere in the world, in a market economy, in a democracy, and you'll see, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or specific answer on the first question. We're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. In terms of diesel prices. So your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, the cost of food and other goods that really rely on it to
So
move
I think
across the country.
it's a more general concern than that. It's diesel prices because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many, many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that and we're watching it, but we're right at the beginning of this, and we don't know how big you just don't know how big this will be and how long it lasts. It may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see. Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP and noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. We actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So it's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time, and so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that, and just briefly on that as well to finish up. You hear the argument a lot, this is a sort of disinflationary story, and if you believe that productivity thing, that should also weigh down on inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really is the demand growing faster or slower than the supply side, and I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
Fantastic. All right. Well, everyone, here we are. Let's debrief. Yeah, I heard some people saying a lot of words being said, not a whole lot to take away. A lot of, hey, this isn't something that I know. And it's fair. I mean, we've got another one-time thing going on, which is a war. And it's very hard to predict how that's going to continue to shape out. It's not funny, but it's almost funny the way that the communication around the war in the Middle East has been continued to be talked about. By the way, we're looking at the NASDAQ here, which has slightly started to slide a bit here. And this idea that basically this is over already, or it will be over very soon. And as soon as it's over, oil prices will come down. Well, that's not something that you really get to determine. That's not something that you get to choose, right? And so the other piece that the administration had been considering was potentially getting involved in the futures market, potentially actually getting the government to step into the futures market. And the CME head came out and said that that would be a really bad idea for the government to try and intervene in oil futures markets. And so let me see if I can find that. U.S. intervention in oil futures would be a biblical disaster, the CME warns. So just in general, right, trying to think about how can you potentially mitigate the impacts of there being higher oil prices for longer and what that's going to mean for the economy. So to what Jerome Powell was talking about, let's go through this from what I've got. So everyone wanted to know, hey, what impact is this going to have on inflation? That was the first thing that everyone wanted to know. the thing that Jerome Powell is still worried about, they're still trying to think about, is what impact will the tariffs have had on inflation? Will that be a one-time thing? Will that be persistent? Or is this something that's already passed by and we're already seeing that start to kind of wean off? But the problem is, and someone brought it up, we haven't really talked to Jerome Powell ever since the tariff ruling was overruled. So we also have to deal with the fact that we don't even know what the actual responses to the overruling of the tariffs are going to be. So you really don't have a clue of what comes next with the tariff situation and what impact that's going to have on inflation. So Jerome Powell eventually acknowledges that part as well. And so the SEP, by the way, someone was asking, are the summary of economic projections. And essentially, this comes out 4 times a year, where the Federal Reserve will release a summary of the Federal Open Market Committee participants' projections for GDP growth, the unemployment rate, inflation, and the appropriate policy interest rates. And so this summary provides information regarding policymakers' views, also on uncertainty and risks attending the outlook. And so this was one of the 4 meetings throughout this year that we were able to get the summary of economic projections. And you also have obviously the dot plot as well, which comes out each and every one of these times, which looks at what is the Fed expecting the future of the rate cut situation to look like throughout the year. So people were asking about the summary of economic projections today. And he basically was saying, well, this is probably the one time where it doesn't mean anything because we literally have no idea what's going to happen next with oil prices and how that's going to impact the economy. I think it's a little bit, I will stake my stake in the ground on the idea that this is going to have an impact on inflation, even as it stands right now, right? So whether or not oil prices continue to go up, whether or not oil prices sustain even the levels that there are now, it really doesn't matter. And because right now, right, it's going to take time for what's happening right now even to fully get to the rest of inflation. For instance, I mean, some people are already seeing gas prices. Guys, in the chat, let me know what you're seeing for gas prices and tell us where you are. Tell me where you are in the US, if you're in the US or in the world, and what you're seeing gas prices at right now. Right. So that's kind of everyone on the ground kind of knows that even already you're seeing a little bit of an increase in the rise of gas prices, and that is going to have an impact meaningfully on the economy. You can't really get around that. So the idea that we just have no idea what's going to happen is a little bit disingenuous. It's going to lead to some inflation, period. So another thing that came up was looking at the labor side of things, right? So the labor market has continued. Monkey business, you're hilarious. The labor market has already continued to be worse, and in fact, we're seeing that the data that we've been getting has shown that it was actually worse than what we were being told. Okay, so he does admit that the labor market is not doing fantastic, but then he's kind of pointed out to this idea that, well, it's okay that we're not getting job growth because there's no new people entering the labor market. Interesting. Let's talk to the young people coming out of college about that. But what's really happening is that people are dropping out of the labor force because they are actually giving up on being able to find a job. It's not that people don't want a job per se, really, right? But people have started to give up and therefore are not counted in the labor force. So yeah, you've got those people coming out of the labor force, which makes it look like, well, when you have people coming out of the labor force because they're quitting, and then you've got the new people coming into the labor force because they're graduating university and things of that nature, looking to get to work and whatnot. And what happens is you get this, because of that effect happening at the same time, you would have no net change in the labor force. So that's how you're able to kind of I imagine this is how you're able to get away with saying that, oh, there's no new change in the labor force, so it's okay that there's no new jobs. But really, right, like for the average everyday person who's going through the path, doing the thing that they think they're supposed to be doing, they're coming into the labor force and they're saying there's no jobs, right? So on top of that, we also see very much so that there are tons of layoffs that are coming. We just had Meta said that they're going to lay off like 20% of their workforce. Holy crap. So Meta considering cutting 20% or more of its workforce, potentially over 15,000 employees, to offset infrastructure costs and finance intense investments in artificial intelligence. So the other thing, speaking on the AI, came up at the very end there, is this conversation around, is AI going to lead to some form of deflation? And could that actually improve the situation with what's happening here. So Jerome Powell, in response to that, is that he said that the increased investment in AI might actually be pushing inflation higher, is what I believe he was saying there. And this idea that this investment in AI and whatnot, and AI in general, could raise the neutral rate in the near term, which I think is a very interesting statement. So the neutral rate, right, is what, for instance, they're trying to find right now, when what they think that they are essentially as close to as possible, which is where it wouldn't necessarily lead to higher inflation, nor would it necessarily weaken the labor market, right? Hopefully, there's this neutral rate where things can kind of stabilize throughout the economy. Now, if the neutral rate needed to be higher, then that would essentially mean that if he thinks the neutral rate is higher, then that means that the borrowing that's done at that rate does not necessarily lead to, let me think about that actually. If you have a higher neutral rate, then that would mean that essentially your borrowing at that higher rate would not necessarily discourage investment to the point to where, so you could basically returns would have to be higher for your neutral rate to be higher. So productivity increasing would increase the returns that companies are getting for their investment, and therefore the neutral rate would need to be higher for AI, for a world with AI being pervasive. That's my interpretation of that. Maybe someone can tell me why that's right or wrong. So the question that he then poses is, the real question here is demand actually growing faster than the supply side of the equation for AI, right, is what he was kind of talking about. This was at the very end of the conversation, of the questions. And so if you have demand growing faster than the supply, prices would rise, right? But if the supply, if these AI companies are able to produce tokens, intelligence, whatever you want to call it, at a faster rate than the demand for it, then would it necessarily lead to higher prices and more investment and things of that nature, is what the question really is in his mind. So anyways, those were some of the main things that he talked about throughout it. Obviously, prices, oil, we talked about the labor market a little bit, and then this question around AI. Stagflation came up. Stagflation, for anyone who's not familiar, is when you have slowing growth while still having rising inflation. And stagflation is one of the worst case scenarios. And in fact, it's pretty much where we're at right now. I think maybe by the definition standards, it's not the case, but we're definitely seeing this across the economy, where you're not seeing an expansion of jobs. You're seeing less hiring, low firing economy is what they're calling it. And in that scenario, you're not getting growth in terms of more job growth, but we are still seeing inflation. We are still seeing very steady inflation holding. And so today we had the PPI come out. Let me go ahead and show you guys that real quick. The PPI and the core PPI came out. The PPI itself was technically higher than the last time. We had a 0.7% increase in the producer's price index versus 0.5% last time around. But then you had the core PPI, which technically came down a little bit from the last read. And so just for some context here, the PPI is a leading indicator of consumer inflation. When producers charge more for goods and services, the higher costs are usually passed on to the consumer. So this is the change in the price of finished goods and services that are sold by producers. This is what the PPI is. What for producers, right? Not for the consumer, but for the people, the businesses themselves. What are prices looking like? Are they going up or down, and how much? That's what you're looking at when you're looking at the PPI. We've seen that basically not the core PPI, but the PPI itself ticking just a little tiny bit higher in a way that at the end of the day shows that we're very unlikely to continue to see any deflationary impacts on the economy. We're going to very likely see CPI continue to rise and PCE. So the market here is reacting with a little bit of a slide. The Fed's not coming to save anyone here. The problem is that there isn't really an easy solution, right? Because what happens here is you cut rates, right? Because people are hurting and whatnot. And then you end up with even higher inflation in the middle of a war where you got higher oil prices. So you can't really very easily just cut rates right here. That's probably actually not a very good idea. But then if you raise rates, and this is the conundrum that the Fed is in right now, if you raise rates, you're going to have an even worse labor market situation where companies are not investing, they're not expanding, they're not looking to hire people, they're not taking that young graduate just because. No, no, no. So this is essentially the conundrum that the Fed is in. Jerome Powell has made it very clear that he doesn't know what's going to come next. Somebody said he gets paid a lot of money to say that much. I don't know. But at the end of the day, what is he supposed to do with all of this data that's in that's coming in? At the end of the day, what the Fed is basically trying to do is save their reputation. Because if they stay neutral right here, if they just stay at the 375 basis points rate, then no one can blame them for what comes next, right? Because if they lower rates and then inflation goes too high, they'd point at the Fed and say, you guys did the wrong thing. What were you doing? But if they were to raise rates and then the labor market continues to fold and we have this massive recession, then you also get blamed for that as well. So at the end of the day, this is them trying to save face and trying to make sure that they don't end up creating whatever thing that they think would happen from this. But what people have been questioning is the current rate actually a neutral rate? Or is this rate actually prohibitive? Is the rate that we have right now the reason why the labor market is doing so poorly? And it's like, to heck with it when it comes to inflation. One of the reporters asked, he said, does the labor market actually hold more weight than the inflation situation at the moment? And Jerome Powell said, hey, I wouldn't necessarily put it that way. So anyways, let's take a quick look at Bitcoin. Not too much of a reaction here, but in general today, it did slide lower. Okay, so it was up at the 75-ish, 75s, almost 76s, and sliding back down to 71K. So that's happening there. I saw a report earlier that economists are basically putting the odds of recession up to 49% for the next 12 months, according to Moody's top economist. So that's another thing to keep an eye on here. We are getting closer to where an actual technical recession becomes more likely due to the fact that growth is likely to slow down. And once you get oil prices, guys, that are too high, once oil prices get too high and stay too high for too long, you actually get demand destruction, which means that you actually don't get the opportunity to people pull back, factories shut down, everything slows down when oil prices get too high. It sounds good for businesses in the beginning, but eventually it just gets too high. So anyways, guys, you guys know how I'm always going to be playing this. I'm always just looking to dollar cost average into the assets that I find would be necessary to continue to get exposure to. At the moment, a lot of people are questioning, why is gold going down? You got gold coming down right now in the middle of this war. Same thing for silver, coming down lower. And at the end of the day, we had a nice retracement and then it went up higher. But we do have the reality that we have an extremely extended gold. So can it come down lower? Yes, it can. It can have a massive retracement. I would say I wouldn't be surprised by a 20+% retracement in the price of gold. But after that, right after you get that kind of a retracement, I would expect things to continue higher. So the way that I play, right, for the assets that I want to own more of, Bitcoin, cryptos of any kind, whatever, gold, all that stuff, is that dollar cost average. It's really hard to beat dollar cost averaging. So as these prices continue to come lower, I will continue to buy and I will continue to accumulate. So that's kind of the way that I'm playing this. Let's look at XRP from our XRP people. It's where we're at. We're pretty depressed. We're at pretty low levels, right, in some of these types of assets. So what am I going to do? I'm going to continue to scoop. Everyone wants to buy up here. No one wants to buy down here. So we're buying down here and continuing to play the game. So anyways, guys, as I have pointed out earlier today, I recently just started a partnership with Caleb and Brown. So if you're looking to get into crypto and you're not sure exactly where to start, or if you're just looking for places that you can know that you can reliably be able to get in and out of your crypto, I highly recommend that you sign up for a free account with Caleb and Brown. You can find the link to that in the description of this video or in the chat as well. You can see Robbie J. Davis is posting the link to sign up with Caleb and Brown. And I also just posted it myself as well. The thing that makes these guys unique is that you have an actual broker that you can talk to. There's all these exchanges and all this stuff going on. And nobody's really going to like help you to talk through the situation of, hey, what's going on here? How do I do this? What should I know that I don't? And Caleb and Brown, their entire business model is set up to actually be able to cater to you as you go through and try to learn more about this technology and actually get involved and figure out how to custody all these different things they're willing to help and talk to you about. So the best thing for people who are veterans in the space who might not need something like that about Caleb and Brown is that they have unlimited withdrawals. So once again, always be set up, always be ready for all of the different scenarios. I've got multiple exchanges that I have setups with. When you go in and you set up your account, you're not done setting up your account until you actually fully verify. You're going to get an email from Caleb and Brown, verify with that email and do the KYC process. Because what happens is if you don't do your KYC, then you don't get to pull your money off of the exchanges. So always go through and actually get that done when you're setting up your account for free. Put your information in and make sure that you're ready to do everything that you need to do to have full functionality on that exchange. So by the way, Jim is my contact over there. We've talked a ton. He's an awesome guy. He's even come and done some live streams and whatnot for my communities. And his email is in the description of this video. So if you're curious to know more, you're just like, hey, I don't really know what I should know, or I just want to talk to someone, email Jim and say, hey, I'm interested in learning more about what you guys are doing. And he'll get back to you ASAP and speed up the process of you getting in touch with a broker over at Caleb and Brown. So that link is in the description and also in the chat. So what's up, guys? Anything else that you guys want to break down? I'm going to have to definitely hop off of here pretty soon. But I wanted to for sure see if you guys have anything that you want to talk about. And yes, as Robbie J. Davis also just said, don't forget to join us over at Memes and Markets as well, because tomorrow we have an incredible guest, especially for anyone who wants to hear more about gold. We've got one of the top gold analysts and sellers in the game coming on tomorrow. So definitely join us over there. We're going to be talking about gold, the war with Iran, and the great reset that is occurring. And you can go ahead and find Memes and Markets. You just type it into Google, type it into, YouTube, and find us over at Memes and Markets. The link in the description, I don't think is going to be working for a second. But anyways, that's all I've really got for you guys today. Any questions that you guys have about what happened, any questions about anything in general, be sure to check out Memes and Markets. We go live every Tuesday and Thursday at 12 p.m. Eastern. We're going live at 12 p.m. Eastern to talk about gold and the Great Reset with a very popular gold guy. And I won't say his name, so you just got to show up. You just got to show up. I won't say his name just in case he flakes, because you know how these people are. No, I'm just kidding. He shouldn't flake. I think he'll be there. I think he'll be there. He'll be there. And if he doesn't, then you guys got to shame him. But no. I've got no filter today, guys. What's on your minds? Talk to me. When do you see this all reversing? I don't know what you mean. All of what? All of what? Do you do any day trading? I do. I do. How do you stay in shape personally? Wow. Well, I go to the gym. I go to the gym almost every day. And I feel bad when I don't. When do you see all this reversing? What reversing, my friend? How do you access crypto assets without being a broker, being your own broker? Well, you need a broker to buy, right? But you can hold your assets offline. Or you can use an exchange. You can use a decentralized exchange to buy certain crypto assets as well. But getting your money into crypto to be able to use a decentralized exchange, you pretty much always have to use a centralized exchange. There's ways to do it, but it's even more time intensive than things that you would otherwise have to do. So it just makes sense to just use a centralized exchange to just buy your crypto. And if you want to send it off, hold it offline, you do that. And when you want to sell, you bring it back to the exchange and you sell it. Right? So you want to always have as many of those venues available to you as possible. Thoughts on ICT color? Yeah, that's personally what I tend to follow is ICT concepts in the short-term trading. Would you say the next big risk is credit markets weakening, such as credit cards or withdrawals? Or withdrawals being the next risk? Hmm. I'm not sure the exact question there. Did I get an econ degree? Nope. Do you prefer calisthenics, free weights, or a mixture of both? I do both. When clarity is passed. Yeah, definitely hit that like button. And if you're new around here, definitely subscribe. Question, are oil reserves the oil they got out of the ground, or is it refined products of it? No, it's a great question. And it's actually not refined oil. It is not. It is oil out of the ground. So the SPR, the Strategic Petroleum Reserve in the US, is not refined oil. That is a great question. Really good question. All right, guys. Negative thoughts on negative comments from Schwartz on XRP. I haven't heard any of that from David Schwartz, the CTO, the previous CTO. Interesting. I haven't seen anything about that. Where can I learn how and best ways to stake on my own digital assets? There with Kraken now. Yeah. When it comes to staking, guys, I typically don't recommend staking with centralized exchanges. Um, Places to learn that. I mean, you can look it up on YouTube. Look up, uh, DeFi protocols and how to use them, like Aave, Compound, things like that. Those are more lending markets than they are technically staking, but definitely be willing to uh, check those out for that type of an exchange or that type of income from that as well. Any thoughts on the tungsten market? I don't know anything about tungsten. What is your chill out, wind down activity all after all work is done? I eat food. I know, like watch podcasts and stuff like that. In the gym is also that time for me as well. That's honestly why I need the gym, is because it's a time for me to kind of like not be on. Color 6688. How deep do I dwell into the ICT space? I mean, all of that stuff is necessary to a degree to really understand what's going on. Yeah, I mean, all that stuff. All right, guys, I'm gonna have to move on. I gotta get it going. Yoshi, I did not see your message. What did you say, Yoshi? Hmm. Would you recommend trading brokerage cash accounts or prop firms? I don't really think that there's like a easy answer to that. I think it really comes down to who you are and understanding yourself. Because I mean, some people will just use those prop firms is like a slot machine, right? And if you're doing that, then you're basically doing the same thing as throwing your money away. But the whole point of them is that you get leverage, right? And if you really understand that, then you can make sense of it and make it work. But I don't know that. I mean, you got to think their whole business model is taking money from people that can't pass the challenges. Thoughts on the Robbins Cup? Yeah, I mean, I don't follow the game that closely, but I know that SGT said he would win it and he didn't. I know that. Do I do cardio? I'm the boss 2047. Yeah, I do. I've been running. It's crazy. I started running last year for the first time in my life, really. And now I'm not like a runner. Like I'm not like one of those types of people, but I do run. How are you now? I said, with 2 young kids, my only downtime comes at 9 p.m. and it doesn't last long. Yeah, that's tough, man. Digital crypto mining, is that a legit option? Digital crypto mining, I mean, it just depends on what you're doing, right? What it is that you're mining and so on and so forth. Susie Salmon, I mean, if you just post your message again. Okay. How will XRP play in this new world order that might come in place, whether USA will lose its power or keep it? XRP is, to me, a political solution to a political problem. The idea is to try to create a neutral bridge asset. Do I know whether or not that will be how it is adopted? I don't know. Would I be positioned for something like that to happen? I would. I don't know if this is any financial advice at all whatsoever. Do you think BTC is a government project? Maybe. It's definitely a political tool. It's definitely a political tool. Do I see people doing price mismatching on Polymarket Calci with bots? Totally exaggerated on Twitter. Seems a little psyopish, but could have been some weight, I think. But it could have some weight, I think. I haven't seen that. I haven't seen it. Yeah, definitely hit that like button if you're still around. Gently tap it, though. How did you start your journey learning about macro, crypto, etc.? I started reading the white papers of stuff, honestly. Reading the white papers of projects is such an incredible way for understanding crypto, at least. And I used to listen to Andreas Antonopoulos, who's like the OG. Let me show you Andreas Antonopoulos. OG. Bitcoin Maxi, OG though. And then macro, just listening to people and trying to read books. There's definitely more to read regarding macro and just investing and stuff. But really, you really just have to keep up with what's happening in real time. And that's how, for me at least, that's how I ended up getting it. Because there's a difference between looking historically at what's happening in markets and then really understanding like what's happening in real time. What happens is the longer you're just paying attention to what's happening in real time, the more the things that are relevant just come up, right? Like even for me, there's so many things that, for instance, I haven't known about until now, like the whole importance of the Strait of Hormuz, or last year was the Red Sea, and in 2021 or whatever, it was the Suez Canal. Like all that stuff, you just end up learning that stuff as things happen, right? And then the next time it comes up, you know so much more. And yeah, and then watching Professor Zhang, he's good too for just learning about the world and how it works, right? You can agree with him or disagree with him, right? But what you're getting is perspective and hearing about things that you might not have heard about otherwise. Let me see if I can get you guys to see my face. All right. Gotta get out of here, guys. I appreciate you so very much. Thanks for coming in. Hit that like button, subscribe. If you guys are interested in crypto or having another exchange where you can get signed up and have a place where you can buy and sell assets and actually be able to withdraw with no limits. And if you want to be able to talk to someone about your digital asset journey in general, then definitely hit that link in the description to sign up for a free account with Caleb and Brown. They are the sponsors of this show. And other than that, I will see you guys tomorrow on Memes and Markets. We're going live at 12 p.m. Eastern. Join us. We're going to be talking about gold. And then I'll be live again on Saturday. So appreciate you guys stopping through. Wishing you an incredible rest of the day. Make it the best day of your life. Until next time. Peace.